Algonquin Power decided to walk away from Kentucky Power acquisition. One of the hedge funds invested in Algonquin Power, Ancora Holding, and another activist investor firm, Starboard, are pressing the AQN CEO and publicly ask AQN management team to start selling $1 billion of assets immediately to reduce the high interest debt on the balance sheet. And CIBC analysts cut the price target of Algonquin Power. Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to briefly talk about the interesting situation of Algonquin Power and Utilities stock. First of all, sorry for my voice, I have a severe sore throat, but just wanted to use this opportunity to make this video anyway. To provide a quick context, I'm not a shareholder in this company, but I'm one of the few people on internet who were interested in this stock from the beginning, and I actually predicted that this company will slash its dividend way before they decided to do this. I also estimated that the fair value of the company is below $9 per share, when the share price was around $20 and everybody was waiting for the stock to hit a new all-time high. A lot of people called me crazy at that time for those valuations, but which were based on their massive debt. But in reality, the share price of Algonquin Power dropped to $8 levels in just a few months. After months of speculation, on Monday, Algonquin Power decided to terminate its Kentucky Power acquisition agreement. This is the reasoning for ending this agreement. After careful consideration, and in light of the evolving macroeconomic environment, our board of directors and management team have determined that continuing with Kentucky Power transaction is not in the best interest of the company. So my initial reaction to this decision was that this is a right decision and this is a right move. However, this is surprising as I'm not sure why it takes a long time for the management team to understand these facts. Kentucky Power is not a bad asset, but it's a bad asset for Algonquin Power. It was clear as a day that this is not a good deal for shareholders, as AQN was already significantly in debt when they proposed to acquire Kentucky Power. And this deal could basically destroy the balance sheet of the company. I'm glad they terminated this agreement, but this is not going to make AQN management team look any better, to be honest. They failed to allocate capital efficiently in the past, and now they are in a situation that they had to slash the dividend, cancel the purchase agreement, and still they have to sell some assets to be able to service their debt. Now we are going into other parts of this update document that is published by AQN management team. They previously mentioned that they are going to sell $1 billion worth of assets to delever the balance sheet, reduce the debt on the balance sheet. This is the question they tried to answer here. Will you still target $1 billion asset sales announcement without a Kentucky transaction? And this is our update. We remain committed to our capital recycling plan and continue to see opportunity to focus the portfolio. We now have more flexibility on the timing of our previously discussed $1 billion of asset sales announcements. And this is the part that pissed off some of the investors and hedge fund managers, especially the part where they mentioned this will give them some flexibility. For example, Ancora Holding Group, which is a hedge fund and one of the largest shareholders of AQN, issued an angry statement after AQN management team announcement. Frederick DeSanto, the CEO of Ancora, mentioned in an open letter to AQN management team the following: "We are pleased that Algonquin has decided to terminate this poorly conceived transaction following months of widespread pushback from shareholders. Given that Algonquin's stock price has declined by approximately 45% over the last 12 months and stagnated over the longer term, leadership needs to establish momentum and execute on its previously disclosed plan to sell $1 billion in assets." And then they continued. "The company's disappointing long-term results and today's extremely challenging market environment should compel the board of directors to keep its foot on the gas. Ancora and presumably many other shareholders believe that the transaction's termination should not provide the company more flexibility to delay asset sales. To the contrary, Algonquin should promptly execute these asset sales in order to refocus Algonquin's portfolio, delever the balance sheet, regain investors' confidence, and restore the company's trading multiple. Failure to do so will send a signal to the market that Algonquin is set on maintaining an unsustainable capital allocation policy, and in turn, likely results in shareholder intervention to put the company on a path to long-awaited value creation. This is very interesting. If you read this carefully, Ancora basically issued an ultimatum for management team at AQN. If they don't move forward with asset sales, they will intervene to put the company on a path of value creation. I personally think Ancora is right here, and I agree with them. Management team at Algonquin made several mistakes in asset allocation in the past and basically destroyed the shareholders' value via these mistakes. They are still hesitant about deleveraging the balance sheet, which is something they had to do years ago, or at least when they saw interest rates are starting to rise. Instead of reducing their exposure to high interest loans, they actually wanted to move forward with adding more debt to their balance sheet and acquiring Kentucky Power. And I'm pretty sure if the market and investors didn't push the management to deleverage the balance sheet, they would still go ahead with the deal. This is where I guess it was the time for investors to step up and come in and don't let the management team to sink the ship and destroy their value. In that regard, I think we should all thank Ancora for giving the management team at Algonquin some guidance and put some pressure on them to do the right thing. After this, we had another update which caused the stock to crash another 5%, and that is a statement from one of the CIBC analysts who downgraded AQN target price from $17 to $10. CIBC analyst Mark Jarvie downgraded Algonquin's New York best list stock to neutral from outperform and slashed his 12 months price target to $10 from $17 in a note to clients on Tuesday. And these are his reasonings basically. We believe the decision to walk away from Kentucky Power deal makes the most sense given the more challenged financial position of Algonquin today, he wrote. However, the path forward to a full recovery will not be easy. The article continues with the explanation of what happened, and then it says he warns the asset sales process could weigh on Algonquin's earnings per share outlook into 2025. Investors' confidence has been severely eroded and will take time and a stronger execution to be restored. Finally, he said, while we see more upside than downside at current levels, we cannot recommend Algonquin with any conviction at this time. So first of all, I want to say this new price target doesn't mean anything, honestly. We should ask this analyst why he had a $17 price target in the first place. I have no idea how he reached that number, but that was clearly wrong. And I believe even the current price target is still wrong. I'm not sure how you feel about this, but I personally would not feel good about making an investment decision based on an analyst price target which can change by almost 50% in a matter of few months. Other than that, I actually agree with the analyst that they probably cannot sustain their EPS numbers in the coming quarters. AQN management team, on the other hand, mentioned in this update document that they will maintain their EPS. So this is the question. Does the termination of Kentucky transaction impact your 2023 adjusted net earnings per share outlook? And the response was no. We maintain our previously disclosed estimated 2023 adjusted net earnings per share in the range of 55 cents to 61 cents. We will see. I don't think they can do this, especially if they have to sell some assets. They have to adjust the EPS to reflect those revenues and that they will lose. Of course, the question is about the Kentucky Power transaction, but I believe they will adjust their EPS guidance in the coming quarters. The last piece of news related to Algonquin released on Friday from Bloomberg, and it was about an activist investor firm, Starboard Value, which apparently is rumored to have taken a position in the company, and they also started to put pressure on AQN management team. And this news caused the stock to actually jump almost 4% on Friday. Starboard, pretty much like the other hedge fund firm Ancora, called for an immediate asset sales. I think AQN management team is really under pressure at the moment, which is not a bad thing. They demonstrated in the past that they can't allocate capital efficiently without pressure from investors, and I think this will actually help the company as shareholders in the future, in the long term. So in the last part of this video, I decided to update my AQN valuation after these adjustments. This is my new discounted cash flow model calculator, which I personally developed via JavaScript. And I believe this is one of the most powerful cash flow calculators that you can find online. It's still in beta. I'm still testing the tool for myself to make sure there is no bug, but we'll provide this tool to public via Patreon very soon. I'm working on that, but life is pretty busy and making it difficult for me to find free time to work on this project. Anyway, to start building the model, I imported a series of general parameters from AQN earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash and or cash equivalents, and their net income per share. I also put my expected rate of return to be around 10% for this stock. Now in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. They will dilute you as a shareholder by almost 20%. I consider them to have almost 6% share-based compensation to reward executives and employees, and be able to grow their revenue by only 1% in the short term, 4% in the midterm, and eventually by 7% in the long term. And I consider the terminal multiple of 12, which is in agreement with historical bear periods of this stock. For the base case or normal case, I considered a little bit better margins, revenue growth, and also lower amount of share dilution, and a terminal multiple of 17, which is historically an average multiple for this stock. Finally, in the bull case or the best possible outcome, I considered a little bit profit margin expansion, 0% share dilution, a small 2% share-based compensation, a 4% short-term, 9% midterm, and 12% long-term growth, and a terminal multiple of 22, which is a bull multiple for this stock. Now, if I hit calculate, the software will give some valuable information about this stock based on my assumptions. First of all, it gives me a tip. The net debt of the business is high compared to its future cash flows, so you may want to adjust the model to take this into account. It basically tells you that this business has significant debt on its balance sheet compared to its future earnings, and therefore you probably want to increase your margin of safety in the calculations. And I usually do this by increasing my expected rate of return. For now, I ignore this. Okay, next it gives you the intrinsic value of the stock in each scenario, and then it will provide you with the fair value estimate, which is around $7.70 per share for AQN, and comparing to the current share price, AQN is still trades at 30% premium today. It is not a buy according to this model. Now, I just want to show you how debt destroyed this company. If I remove all the debt from the balance sheet in these calculations, so I assume the net debt is 0, and hit calculate again, you will see that the stock is a buy today. So the most important problem of AQN stock is their debt. And I think managing this level of debt would be extremely difficult for the management team at Algonquin with their current strategy. I wish you shareholders of Algonquin all the best and hope the management team can turn things around for you. But personally, I decided to not move forward with the stock unless it comes down to at least $8 levels again. There you are, guys. I hope you enjoyed the video. I will come back with a new AQN video once things settled and they reported their earnings. But until that time, I see you guys in the next video. Farewell.